We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. Today we're going to review a stock symbol and also recap on some Richard Ney logic. What's the point of Richard Ney logic? When a security has a limited supply of float, which is freely traded, the battle of demand and supply for the float can be fairly examined to determine which force has dominance. This determination allows the retail trader to run with the composite man to profit. I've just made a note here that cryptos and equities have a limited float. The float in equities can change through rights issues or obviously share buybacks. ETFs and futures, they can write contracts. That's more float out there, and same with the ETFs. Equities and cryptos are more pure form of float, so the supply and demand battle can be a lot clearer. But that doesn't mean to say ETF and futures doesn't work, but quite frankly equities and crypto is the better review. Right, carrying on. To find evidence which proves either demand or supply is in control, the investor must look at patterns of price and volume. Dominant demand or supply will be proven by price and volume is in the correct place on the chart. Traditionally, good demand is a higher volume on the upswing and less volume on the downswing. Good supply is a higher volume on the downswing and less volume on the upswing. Of course, real life is never this easy. Therefore, we work with the probabilities and fundamentals as best we can. readtheticker.com custom indicator RTT OBV Wyckoff allows the chartist to quickly judge if price and volume patterns support either a dominant demand or supply view. As the modified version of OBV, or on balance volume, emphasizes volume and price breaking into new ground. Breaking into new ground means breaking resistance, support, or jumping a creek, or breaking the ice, which are technical Wyckoff terms. Helps to evaluate signs of strengths, last points of support, last points of supply. So you get an idea if volume and price are acting in the correct manner, which show there's a shift from supply to demand, or a shift from demand to supply, or if it supports a markup process. As we go along in life, sometimes some strange volume turns up and we want to notice this, and we have to explain it away with our Wyckoff logic. Okay. When reviewing price and volume patterns, it is very important to understand the story behind high volume and its relative price action. Is it true demand, or is it true supply? On your chart, all above normal volume must be explained as to its part in the supply and demand determination. So any chart you're looking at, you see high, low, medium and high volumes. You must examine the high volume parts in your chart to see whether that is demand or that is supply with the application of your Richard Wyckoff logic. Why? Because volume of size is 90% the big boys. You and I can't do that. We do not matter. readtheticker.com RTT OBV Wyckoff indicators help to resolve the high, medium, low volume story. It helps shows when something is different. Something's happened in the chart. And when you're looking through 20, 30, 40, 50 charts and you see nice price action, you want to see how the weighted RTT OBV volume indicator is tracking that. Is it similar? Is it different? Is it showing different volume patterns? Does it confirm or deny the price action? So you can't look at an OBV indicator without understanding Richard Wyckoff laws of supply and demand with price relative to volume. Now, as part of the RTT Plus service, which includes the RTT WC service or the Wyckoff campaign service analysis, we provide a list of the Wyckoff Ney rules for your review. It's a bit like volume spread analysis, but we want to know what happens with a high volume, low spread, high volume, wide spread, average volume, low volume, narrow spread, and it just goes through a checklist of when to consider when the demand is strong or supply is strong or whatever. So once you understand those, there's a lot of information about that. You can start to analyse your price chart, and you throw it in with your on-balance volume indicator, or our customised on-balance volume indicator, to see how demand and supply is controlling or not controlling a chart. It's also a good time to review the Richard Wyckoff laws. Now, when you're looking at price and volume, most important law is to understand is the law of efforts versus results. Simply stated, if there's an effort, a result must be in proportion to that effort, and it cannot be separated from. If it is not, it's an indication of other principles and actions. Think of the effort as volume on the move, and as a result is the corresponding price action. What this basically means is if you've got a high volume and you haven't got a relatively well-performing price action, then maybe that high volume is not all demand. Maybe it's something else. There's something else going on. So what we want to see is a relative volume to relative action. If you've got high volume and a wide-ranging bar, it's good to see that off a low. Whether the lows at like a low point in the chart, like a 10-year low, or it's after a long period of consolidation, it's breaking out, like it's jumping the creek or jumping over resistance. So high volume, wide price in the right place means something. High volume with price action could actually be quite bearish. It's doing a blowing off top. It's going up high and it's getting ready to sell down. So it's not a good place to invest. Now, the law of effort results is a subset of the law of cause and effect, because we want good effort versus results in our building of our cause and effect. Right? So cause and effect is a subset of supply and demand. So supply and demand is the overall philosophy of the two laws of cause and effect and effort versus results. So when you're looking at the on-balance volume indicator, it highlights price and volume action, because the on-balance volume indicator is a weighted price moving indicator, weighted by volume, and our customary OBV indicators help measuring when price goes into new ground, weighted by the volume. It just highlights, say, look at me, what's going on here, and see whether price action and the volume action is in sync. Let's have a look at an example. Right, here we have HighPoint Resource Corporation. Now, the HighPoint Resource Corporation, they're undergoing a bit of a turnaround. They used to be a gas company, and now they're turning into an oil company. As you can see that, the stock price has fallen. What's good to note is our RTG steps indicator shows a base between $0 and $10, and we notice all the big volume action. Okay, so one, we like our cause. It's a cause over a long period of time, so we're talking 2 or 3 years, which basically means restructuring. Okay, now if you notice here, we've had our peak sort of low about here, a little dull period, and now we're getting some build up because the earnings is coming up, and obviously the earnings is coming up soon, and crude oil has been creeping up. So if crude oil continues to keep up, or just hold its price, doesn't have to go anywhere as long as it doesn't plummet, and this company turns around and starts providing an oil service, then revenue and profit should return. And then once they've written off all their restructuring costs and what have you, you can find more about it. But this was what you did classify as a turnaround stock. So we've got lots of volume there. As you can see, I've marked these monthly charts. The monthly charts, you've got to look at monthly charts. They're just great. Blue bars for up, red for down, and the relative volume. And you can see our average volume here. So I want to know. Obviously, we've got supply. We want demand. I'm putting my Wyckoff thinking on. At the moment, we're going to scroll down to our on-balance volume indicators, and as we can see here, this is my the site's RTT on-balance volume version 1, or Wyckoff 1. What this does, when price breaks into new ground, it adds the volume. When price breaks into new ground down, it subtracts the volume. And a volume is a continuous move. It keeps on subtracting a volume. It's not weighted. The volume just adds up and down. And as we can see here, we see price is within a range, but as you can see here, the OBV breaks the range, and it breaks down because there's lots of volume. Now, if we put our Wyckoff hat on, we would say yes, there's lots of volume in this downswing here. But what do we notice? We notice that the spread, or the difference between the high and the low, is not that great. All that volume, it's the down price. We know the big boys in the market like to accumulate on down swings. So we've got this massive volume here, so that this basically tells me that there's lots of accumulation going on here. And the chart wasn't damaged because price did not make any new lows. So that definitely, I've instantly found that attractive in the chart. We have our, our selling climaxes and our testing going on here, our automatic reaction, a bit of a test there. So when you see this action, when I see a divergence here, I see this divergence. Alrighty, divergence there. Let's have a look at that. I say, big volume action, less price action. That means something's going on, some buying is going on here. And we see what we see is we see an equal move in volume here. So from this point on, volume and price are acting in sync. The only thing I'm a bit cautious of was this action around here. We had an up day, and the volume wasn't that great. So maybe got a bit of ahead of itself. Maybe an announcement, something went on there. So it's a bit. Would have been better to see more volume come in there. But that's okay. But we'll keep an eye on that. So that's OBV Wyckoff 1. Now we're going to look at another indicator. It's Wyckoff 2, on balance volume, Wyckoff 2. This is where the volume is weighted relative to the breakout. So now we've got we can see here, price is breaking new ground. See how it closes much higher than these two bars. This closes much higher than that bar. So price is breaking into new ground. The volume on those bars is given a greater weighting in the calculation, more so than the volume on a bar like here, because it's not making new ground. So these two bars here, they're not making any new ground, so they're not that special. Whenever price makes new ground or breaks into it through resistance, the weighting changes relative to the price move. So what does that mean? Well, that basically means people are willing to pay more money by hitting the bid, breaking resistance, jumping the creek or what have you. So the price volume action tells me a different story. And so here I see, look at this, we've got very strong divergence here compared to that. So that basically means the price on the downswing couldn't really break into new ground. That is very, very bullish. It makes me a bit excited. And the price jumps up to here, as you can see. Right? Is it? And there's a divergence here, very strong divergence, which shows this is a very important part of the demand equation. We had a bit of a sell-off here, broke into new ground there, and as we talked about before, as price moves down, these bars aren't really breaking into new ground. There's a bit of this bar is interesting because we have it does break into new ground, as you can see, gets below there. The volume's quite high, but you should also must notice the spread isn't that great. See that spread there compared to the spread here and the spread there? That's a narrower spread with extremely high volume. That means whatever supply is going on has been absorbed. So that's bullish. That's why it wasn't so penalised, because the weighting wasn't so high because of the narrow spread. So as we come down here, drags the volume down, but really the whole picture here is bullish. And as we see here, because this bar broke into new ground here, this bar broke into new ground, that volume there got greater weighting. So this here is a picture I like. The volume is in the right place. There's better volume on upswings. Price is breaking to new ground. It's jumped the creek there. You might say it's a jumping in the creek there. All right, we've got to get over that. We had another jumping in the creek there. Creek 2, sorry. And now we've got a much more important creek up here to get over. So this still might take some months to get over, but as you can see, the whole supply and demand picture has definitely shifted away from supply, moved into demand. Now we wait for the catalyst to break higher. The on-balance volume tools that I've used highlighted the areas that one should focus on in the chart. Okay, so the monthly chart did all that, especially on consolidations that are greater than 12 months. And also I can do the same thing with the weekly chart. Here's the on-balance volume indicator for just simply adding and subtracting volume. And here's the on-balance volume weekly indicator for the weighted volume. And as you can see, it gives a very good picture. Now, if I'm looking at the weekly chart, I see that massive volume spread. It's actually quite bearish. All that volume, price didn't really go that far, so I would have been a bit nervous about that. So now I see it basing. This is the bullish picture here. It starts getting bullish here. All that volume on a downswing, breaks into new ground, but it doesn't go any low. So that big high volume bar there, alright, breaks into new ground just a little bit. Doesn't go down. That is definitely accumulation. It's a good sign of that week. So buying after that would have been very, very good. And we get a similar a similar story again here. About 8 weeks ago, a bar down, a little bit high. Oh, the volume isn't that great, but didn't go anywhere. So once you can see the accumulation and the markup process is the market's starting to realise that some good news might be coming for this company. Okay, so that's how we use on balance volume, the customary indicators, to highlight the price and volume action, to request the Wyckoff investor to say, look, start applying your Wyckoff volume, price, spread rules to these critical areas in the chart. If you can see the good action in the monthly and weekly charts, you're going to realise that demand has shifted to supply, or supply has shifted to demand, and you apply your Wyckoff logic. It's a very good tools for reviewing many charts. Thank you very much for watching.